a lot of retirees who give to charity are paying more in tax than they have to, especially if they have both retirement accounts like an IRA or 401k and non-retirement accounts like a brokerage account. This is because there's a few small tweaks they can make in their charitable strategy that can end up getting more to charity and less paid in taxes to the government. Now, I'm aware that getting tax benefits, that's not the main reason or motivation that we're charitable. But if we can make a few easy changes to get more to charity and pay less in tax, why shouldn't we? So in this video, I want to share some common mistakes that we see retirees make and how to make sure that you don't make those as well. We're going to go over bunching, taxable accounts, my personal favorite, and avoiding IRA tax. But before we do, I'm Tim Meisenheimer, and Dave and I have been helping people retire for the last 14 years. We help a select number of high net worth clients at Streamline, but we created this channel to help share what's been working with those who are not clients. Be sure to subscribe if you like these retirement specific videos. So let's get into mistake number one, which is taking the standard deduction, but not getting any tax benefit by giving to charity. This is a common mistake that we see, and by using a technique called bunching, you can decrease the amount of taxes that you pay. So let's take a look. Jim and Cindy, they file their taxes married filing jointly, and the current standard deduction for that is $25,900. Now they're filling out their taxes and they're looking at their itemized deductions, which is medical, interest like mortgage interest, SALT, state and local taxes, and C is charitable. And let's say it's $5K of medical they can deduct, $5K of interest, mortgage interest, $10K of state and local taxes, which is the limit, and then another $5K of charity. So overall, this looks pretty good, but when they add that all up, they are below the standard deduction by $900. Now, if they took their charitable giving of $5K and they bunched it, and so over 2 years, they're getting zero tax benefit from charitable giving. But if they change that $5K to $10K and did 2 years worth of giving, you can actually do this for 3. In 1 year, all of a sudden, their itemized deductions add up to $30,000, an extra $5,000. So let's take a look at the difference between these two right here, $25,900 and $30,000. Now they have an extra $4,100 that they can deduct off of their taxes. This might save them $1,000 in taxes, and the next year they're getting the same tax benefit by taking the standard deduction, because the next year they'll have zero in this category. So this might be $1,000 in savings. What we see a lot of people do with that is they'll split it between the charity and themselves. So an extra $500 of impact to that charity that they care about, and an extra $500 for them, $1,000 less for the government. So bunching is a great strategy. The second mistake that we see is gifting cash and selling appreciated stock to fund that gift. I always say, never write a check to charity again if you can help it. Wait, what? I know, that's shocking. But here, I'll tell a story to give an example. Let's say Debbie wants to give $10,000 to her church. And she goes to her brokerage account and says, you know, that tech stock that I bought for $2,000 is now worth $10,000. So I'll sell that $10,000 and give it to my church. When she does that, she's going to get a tax deduction, but take a look right here. There is $8,000 of capital gains. And you want to make sure you own this for over a year to make sure it's long-term capital gains. But she's paying tax on the $8,000. That might be, let's say, $2,000 in tax to do that. So she's getting a tax deduction to give the gift, but she's paying tax in capital gains along the way. Here's the better way to go. She gives her shares, so her $10,000 of shares directly to charity. We always say give shares, not cash. What that does is you give the shares to the charity, they sell it, they turn it into cash, and then you've avoided that $2,000 in tax right there. That's one of two options. That's giving it straight to the charity. You can also take those shares and give it to what's called a donor advised fund. Donor advised fund is really like a charitable checking account. Again, you give the gift, you get the tax deduction right away in that year you gave the gift of shares. The donor advised fund, they turn it into cash. And then from there, you can give, this is for somebody who wants to give to multiple charities, multiple organizations, or you want to spread your gifts out over multiple years and you don't want to give it all at one time. Hey, if you're liking this video so far, please let me know by clicking the like button below. Strategy number 3. Oh, before I get to mistake number 3, one example here that we see a lot with appreciated stock, there's also 2 other categories of people that might be you. If you're a business owner and you're selling your business and then you're going to do a lot of charitable giving as a part of your tax strategy, that's normal. Look at seeing if you can give some of your shares of your business away to charity first. That will save massive amounts of tax. We see it a lot where the business owner sells their business and then they're writing checks to charity afterwards. You can save so much in taxes by really reviewing, could you give part of your business away first? Also works with real estate. Before you sell those buildings, before you sell those real estate holdings, can you give part of them away first before the sale? And then you're going to save a lot on taxes. It's going to mean more to charity, less in tax. Last mistake number 3 is gifting cash and taking your RMD. So this is for those of you who are 72 or older. It's actually for those of you who are 70 and a half or older. This might not be needed and you're going to be paying tax on it. So let's take a look at Don. Don wanted to give $7,000, off the screen, $7,000, here, I want you to be able to see it, to the local food bank. This right here is a loaf of bread. Well, that's pretty good. Then he has an IRA and he gives $7,000 to himself to meet his RMD requirements. So $7,000 to the food bank, $7,000 from his IRA. I'm making the numbers easy. If he's in the 22% tax bracket, he's paying probably an additional $1,400 in tax. It's actually closer to $1,500 for the 22% tax bracket. And he's getting a tax deduction for making the gift to charity, maybe, unless he has the standard deduction like before. If he does not need his RMD, there is a great opportunity for him to give that RMD directly to the food bank. He gets to meet the RMD requirement and he still gets to give that gift to charity. Also, he doesn't pay tax on this distribution. It's called a qualified charitable distribution. If you're 72 and you're in RMD land, you can do this. You can actually start at 70 and a half. After you're 70 and a half, you can start this strategy as well. So this is something that we help our clients with, but you really want to coordinate it closely with your tax accountant. The tax reporting on these distributions, it's not great yet, it'll get there, but you need to make sure you know that you're giving a qualified charitable distribution and how to reflect that on your tax return. And this could save $1,500 in tax for Don. So this is powerful stuff. If you liked this, and you like these retirement specific videos, like and subscribe. If you want to take advantage of some of these strategies, look for the free philanthropy session link in the description below. We'll see you in the next one. Thanks.